The information in this episode is current as of the date recorded and is not intended as financial, tax, or legal advice. You should consult your tax, financial, and or legal advisors before implementing any transactions and or strategies concerning your finances. And with that, let's get to this week's episode.
Hi, everybody. Dr. B here with John G. Ullman and Associates. This is our market update for the week of September 16th. If you're new to the channel, welcome and thank you for joining us. The goal for our channel is for me to leverage my economics background to help explain to you what's happening in the economy and the markets. Our hope is that it'll help you use these insights to better navigate the financial landscape. So with that, let's hit the books and get up to speed on the markets. All right, let's start with last week. So the big news last week was the Consumer Price Index, registering a 2.5% increase from 2023 to 2024. The reason this is significant is because, as we all know, the Federal Reserve has been fighting inflation, trying to bring it back down to their target of 2%. This 2.5% increase year over year was the smallest increase we've seen since 2021. The conclusion to draw from this is that the battle is moving in the right direction, but we're not quite where we want to be yet. So the most recent consumer sentiment survey coming out of the University of Michigan showed that consumers, although cautious and still concerned about inflation, are becoming slightly more optimistic about the future. This is fantastic news because the United States economy is driven in large part by consumer behavior. We also saw some positive information released by Freddie Mac in the Primary Mortgage Market Survey. The biggest takeaway from this survey was the fact that mortgage rates in the United States have dropped by nearly a full percentage point in the last 12 months. For those individuals in the housing market or desiring to buy a home in the near future, this is fantastic news. Last of all, bringing it back to the markets, we saw all three markets rise last week. The Dow Jones Industrial Average increased by 2.6%. The S&P 500 increased by 4%. And the NASDAQ increased by an incredible 6% in 1 week. Now, of course, these returns won't persist forever. Markets tend to rise and fall over time. But last week was definitely a positive week as far as stocks are concerned. The hot topic for this week is interest rates. Everyone is eagerly awaiting the Federal Reserve's decision on September 18th regarding the target range for the federal funds rate. So, for those of you that may not know, it's not actually the Federal Reserve chairperson who changes these rates, but it's a committee. It's called the Federal Open Market Committee, sometimes shortened to FOMC. And this committee is made up of the 7 Board of Governors representatives in the Federal Reserve, as well as the 12 regional Federal Reserve Bank presidents. All 19 of them meet. All 19 of them discuss the economy in their respective regions and concerns. And at the end of this meeting, at approximately 2 o'clock Eastern, the Federal Reserve chairperson will release a statement and then host a press conference where they announce the Federal Reserve's decision on interest rates. Right now, both the markets and economists believe that the Federal Reserve will be cutting interest rates at this meeting and beginning a period of relaxing or declining interest rates in the near future. The big question, of course, is whether the interest rate cut will be 0.25% or 0.5%. The economists seem to be leaning towards 0.25%, while markets are very clearly leaning towards the 0.5%. So the big question is not whether the Fed will cut, but how much will they cut? And of course, following this week and following this meeting, the conversation will continue as the Fed continues to cut and relax interest rates to try to support the economy. In some non-Fed related news, the Department of Commerce released retail sales numbers this week that demonstrated a slight increase. This surprised most economists and analysts who had expected a slight contraction following a large increase in July. The fact that consumers continue to spend and continue to grow and increase their retail sales demonstrates that the consumer may be cautious about inflation, but is still spending money. The year-over-year increase in these retail sales was approximately 2.1%. So as the economy changes and evolves over time, one thing that we like to see consistently is consumers feeling comfortable and having the confidence to spend money in the retail sector. We also will see some information later this week on housing, manufacturing, and leading indicators. Leading indicators are statistics that economists watch that tend to demonstrate that there may be reason for concern or reason for celebration prior to the larger, more common statistics demonstrating good or bad news. We'll talk more about the leading indicators next week once we have the actual information, but this is a really helpful index and a set of really helpful information to understand where the economy is going in the future. As we look to the future, the election is on everyone's mind. We're still approximately a month and a half away from the election itself, but the polls are incredibly close. As an economist, when I see polls within the margin of error, it tells me that this race could go either way. As an advisor in the financial space, my suggestion to you is don't follow the polls. Stick to your financial goals, reinforce your long-term investment goals, and continue to follow your plan. This election will come and go as many have before it, and one of the best financial strategies during an election is to ride it out. Don't let your politics influence your financial goals in a way that could actually harm your success. September and October are historically tough months in the market. In an election year, this volatility is increased even more. Make sure that as we move through the next few months, you monitor your financial goals, you stay calm, and you speak with trusted financial advisors before making any large movements in your investments or your plans. Sometimes changes are inevitable, but you don't want to change based on the whim of politics or the whim of the market moving up and down. The end of September will wrap up the third quarter of 2024. This is an incredibly important time because as the quarter ends, we'll start to see earnings reports from some of the largest companies in America. How these companies' earnings in the third quarter performed will provide a lot of insight and guidance on what we should expect for the remainder of the year and even the beginning of 2025. Currently, the 12-month forward price-to-earnings ratio, which helps us to understand how the price of a stock is related to the earnings of the company itself, is exceptionally high. The current forward 12-month PE ratio is above the 5-year and the 10-year average for the S&P 500. But with that said, it is currently slightly lower than some of the ratios we'd seen earlier in the year, as well as the ratios reported in 2020 and 2021. The caution, of course, is that as each quarter passes, new earnings are reported and these ratios are recalculated. It's incredibly important, if you're watching the markets, that you listen and pay attention to these earning reports and watch how the price of the stocks fluctuate in response. Although we are at a high P to E ratio, that doesn't necessarily mean that the market will move up or move down in the future for sure. As with every period in time, the market is notorious for volatility. And as we move through this difficult period of September and October and a big presidential election, don't expect the volatility to go away. Thanks for joining us this week. As always, we'll continue to watch the economy and the market's reaction and do our best to bring you the information that'll keep you up to speed. Join us next week for our next market update. And don't forget to take a moment to like and subscribe to this channel if you found this information helpful. Thank you, and have a great week.